Welcome back to another deep dive with us. Today we're going to be tackling a real head-scratcher.
Yeah, a bit of a paradox.
Exactly, and this is something that's got the markets talking, and we want to figure out what's really going on.
For sure, it's definitely an interesting situation.
So to set the scene, we're seeing the U.S. dollar surge.
Yeah, to two-year highs.
Which, on the surface, wouldn't be that strange, right?
Not necessarily, no.
But here's the thing.
Yeah, the catch.
This is all happening while the Federal Reserve is cutting interest rates.
Right, and that's what makes it so puzzling.
Usually you'd expect the opposite, right?
Exactly. Rate cuts typically make a currency less attractive to investors.
Lower returns equal less demand.
Which pushes the value down.
So why is the dollar defying gravity this time?
That is the million-dollar question, isn't it?
What's the secret sauce? What are we missing here?
Well, luckily we've got some really insightful analysis here from SourceName that dives deep into this mystery.
Great, and I'm already sensing this isn't just, some short-term blip.
This dollar strength, it could be a sign of something bigger. Some pretty significant shifts in the global economy, actually.
Okay, now you've got my attention shifts that could impact everyone, not just Wall Street, right?
Absolutely. It's not just a trader's game anymore.
Okay, so let's dive into those shifts. Our source highlights some pretty surprising factors.
Yeah, some really interesting things at play.
Like a hidden message from the Fed, the lasting impact of those Trump-era tariffs.
And how the U.S. seems to be going against the grain compared to other major economies.
So much to unpack.
Where do we even begin?
Well, let's start with the most obvious thing. The dollar index, it's up.
A substantial amount, actually 6.4% to be precise.
Wow, to 107.82.
You got it. That's not a small jump.
No, it's not. And it begs the question, why is this happening when conventional wisdom says the dollar should be weakening?
Right. It's like watching a car speed up while the driver slams on the brakes.
Something doesn't add up.
Nope.
So walk me through this. Why is this dollar surge so unusual in the context of these rate cuts?
Okay, so picture it this way. When a central bank lowers interest rates, it's basically making their currency cheaper.
Cheaper relative to other currencies.
Exactly. It's a way to boost their own economy.
By making exports more competitive.
And imports cheaper.
But that's not what we're saying with the dollar right now.
Not at all. It's holding its own.
So what's different this time? Why is the dollar acting like the life of the party, even when it's trying to play it cool?
Well, part of it has to do with the safe haven status of the U.S. dollar.
Right. The good old greenback. It's seen as a safe bet.
Exactly. Especially in times of global uncertainty, investors flock to the dollar.
Like seeking shelter in a storm.
Exactly. It's a stable and reliable asset.
Okay. That makes sense. But is that the whole story? Is there something else going on here?
I think there's another piece to this puzzle, and that's the whole idea of the Fed put.
Ah, yes, the Fed put. Remind us what that is again?
Sure. So basically, it's this belief that the Federal Reserve will always step in to protect the market if things go south.
Like a safety net for investors.
Right. And it can lead to a bit of a moral hazard.
Meaning investors might take on more risk because they think the Fed will always bail them out.
Exactly. And that's what we might be seeing here. The market's acting like there's an implicit Fed put at these levels.
Even with the rate cuts.
Right. They're expecting more cuts to keep the economy humming along.
Even if it means accepting higher inflation down the line.
Potentially, yes.
But isn't that a dangerous game to play? What if the Fed doesn't come to the rescue like everyone's expecting?
That's the big question, and this is where things get interesting. While the Fed did cut rates in December by a 0.25 percentage point.
As many expected.
Right. They also gave some pretty strong warnings about inflation being stickier than they'd like.
So it's a bit of a mixed message then.
It is a bit. They're trying to appease the market with the rate cut, but also signal they're not going to let inflation run wild.
Having your cake and eating it too.
Exactly. A delicate balancing act.
And if we look at their projections for inflation.
Their median PCE inflation projection for 2025 actually jumped.
Jumped to
2.5%, up from 2.1% just a few months ago.
That's a pretty noticeable increase.
It is, and it suggests they're more worried about inflation than their rate cut might suggest.
Right. So behind the scenes, they're sending a signal that maybe they're not as dovish as the market is hoping.
Precisely. They might not be as inclined to cut rates aggressively going forward.
Okay, so we've got this disconnect between what the market expects and what the Fed is signaling.
Right, and that creates uncertainty and potentially risk for investors who are banking on a very accommodative Fed.
This is already shaping up to be a wild ride.
Buckle up.
But before we jump into the potential scenarios and what this means for investors, let's talk about another crucial piece of this puzzle.
What's that?
The lingering impact of those Trump-era tariffs.
Ah, yes. Those trade wars, they might seem like a distant memory.
But they're not.
No, they had a profound effect on global supply chains, and we're still feeling the effects.
You're talking about those threats of 25% tariffs on goods from Mexico and Canada.
Right, and an additional 10% on Chinese imports,
It was a tense time for global trade.
to say the least.
And even though some of those tariffs have been rolled back,
They triggered a cascade of disruptions.
businesses had to reroute supply chains, costs increased
And eventually, those costs got passed on to consumers.
in the form of higher prices.
Exactly.
Yeah.
So even though the trade wars have cooled down,
The inflationary pressures they unleashed,
are still simmering beneath the surface,
it's like trying to put out a fire with one hand.
while someone keeps adding fuel with the other.
A perfect analogy.
And to make things even more interesting,
There's more.
always,
Yeah.
we need to consider the global context. The U.S. economy doesn't exist in a vacuum.
Right, we're in a globally interconnected world,
Exactly. What happens in other major economies has ripple effects.
for sure. So what's happening elsewhere?
What we're seeing right now is a pretty stark divergence in monetary policies.
Explain.
Okay, so while the U.S. Fed is taking a fairly cautious approach with these rate cuts,
Trying to walk that tightrope.
right, other central banks, particularly in Europe and Japan, are being much more aggressive.
So they're slashing rates.
In some cases, yes,
Mm.
they're facing different economic challenges and have different priorities.
But it creates this kind of monetary policy tug of war.
In a sense, yes, everyone's pulling in different directions.
And how does this global mismatch play into the dollar's unexpected strength?
It's all relative. When other central banks cut rates more aggressively than the U.S.,
Their currencies become less attractive.
compared to the dollar,
Yeah.
exactly. So even if the U.S. is cutting rates,
The dollar can still strengthen if other currencies are weakening faster.
it's like that student who looks even smarter when everyone else is struggling with the test.
Great analogy.
Yeah.
So it's not just about what the Fed is doing.
It's about what everyone else is doing, too.
We've covered a lot of ground here. A cautious Fed, the lingering impact of trade wars.
And a global monetary policy landscape that's more diverse than a Jackson Pollock painting.
It's a lot to process.
It is, but understanding these forces, it's essential for navigating the markets.
And that's exactly what we're going to delve into in the next part of our deep dive.
We'll explore the potential scenarios that could unfold.
And most importantly, what you can do to position yourself for success in this ever-changing landscape.
Stay tuned. Welcome back to our deep dive into this dollar mystery.
Yeah, it's a real puzzle, isn't it?
It is. And we were just discussing, how those trade wars and this global divergence in monetary policies.
It's like we're putting together this giant financial jigsaw puzzle.
Yeah, with all these interlocking pieces.
We've got the Fed trying to balance inflation concerns.
With market expectations.
the ghost of tariffs still lingering.
And a global monetary policy landscape that's anything but predictable.
Exactly. So much to keep track of.
And it's crucial for investors, to trying to make sense of all of this as we head into 2024.
Absolutely. So let's get practical. What does all of this mean for, the average investor out there?
Right. How do we actually navigate this?
Thankfully, our source lays out 3 potential scenarios for the coming year.
Each with its own implications.
Okay, little crystal ball gazing.
Why not? Let's start with the base case, what they consider the most likely outcome.
Okay, so what are we looking at?
They give it a 60% probability, and it basically says that the Fed will end up cutting rates less than the market is currently anticipating.
Right, because right now sentiment is leaning towards a more dovish Fed.
Exactly.
Yeah.
One that's willing to prioritize growth even at the risk of higher inflation.
So in this base case scenario, the Fed taps the brakes on rate cuts, keeps a close eye on inflation.
And only eases policy gradually.
Okay, and what does that mean for the dollar?
Well, in this scenario, the dollar likely remains strong.
So it continues its reign.
Potentially, yeah. Trading maybe in a range of 105 to 110.
Okay, so still pretty strong.
Mm-hmm.
And what about, the impact on other investments?
Well, this continued dollar strength, it could put some pressure on equity valuations.
Especially for those companies that rely heavily on international sales,
Right. A strong dollar makes U.S. goods more expensive for overseas buyers.
which can hurt their bottom line.
Makes sense.
All right, so that's the base case. Now let's talk about the more optimistic scenario. What would need to happen for that to play out?
Well, the optimistic scenario hinges on inflation cooling down faster than expected.
So inflation cooperates and comes down.
Exactly. They give this scenario a 25% probability.
Okay, and if that happens,
Well, then the Fed would have more room to maneuver. They could cut rates more freely without stoking those inflationary fears.
it's the Goldilocks scenario. Inflation comes down, The Fed eases policy, and everyone's happy.
Right. But realistically,
Yeah, how likely is this happy ending?
well, it's not the most probable outcome, but it's certainly possible.
Finger crossed.
A lot will depend on factors like energy prices,
Yeah,
global supply chains, consumer spending.
those are some big variables.
They are. And in this optimistic scenario, the dollar could weaken somewhat,
So it comes down from its throne.
maybe a bit, perhaps trading closer to the 100 to 105 range.
Okay, so a bit of a reprieve for those other currencies.
Yeah, and this would generally be good news for risk assets globally.
Because a weaker dollar tends to boost those emerging markets.
Exactly. And those riskier investments that investors favor when they're feeling bullish.
Makes sense.
Yeah.
Okay, so we've got a scenario where the dollar stays strong and one where it weakens a bit.
Mm-hmm.
Now let's talk about the scenario that keeps analysts up at night.
The dreaded risk scenario.
Exactly. What are we looking at here?
So in this scenario, inflation unexpectedly surges higher.
Oh, no.
Yeah, defying the Fed's attempts to get it under control.
And they give this...
A 15% probability.
Okay, so not the most likely, but still a possibility.
Unfortunately, yes. And if this were to happen,
What would it mean for the dollar?
well, we could see the dollar surge even higher,
Oh, wow.
maybe exceeding 110 as investors flock to its safety amidst all the uncertainty.
So a flight to safety,
Exactly. And this could trigger a significant repricing of risk assets.
especially in those sectors that are sensitive to U.S. monetary conditions.
Things like emerging markets, high-growth tech stocks.
So this is the scenario where things could get really messy.
It is a potential worst-case scenario. A repeat of the inflationary roller coaster we've seen in recent years.
A stark reminder that we shouldn't get complacent.
Exactly, even with the market's current optimism.
So with all these potential pitfalls in mind, what's the main takeaway for investors?
Well, I think the key is to understand that the market right now, it might be a little too optimistic.
Not fully grasping the potential risks.
Exactly. And that means there's room for a correction if things don't go as planned.
So buckle up.
And don't get complacent.
So given all this uncertainty, what's the smart approach for investors?
I think it comes down to being selective and managing risk carefully.
Don't just blindly chase returns.
Right. This isn't the time for that. It's about diversification.
Spreading your bets.
Exactly. Across different asset classes, sectors, and even geographical regions.
So don't put all your eggs in one basket.
Wise advice. And our source also delves into some specific recommendations for sector allocation and fixed income positioning.
Okay, what do they suggest?
Well, in terms of stocks, they really emphasize the importance of focusing on quality companies.
Companies with strong balance sheets.
Right, ones with pricing power and established market leadership.
The ones that can weather the storm.
Exactly. And for fixed income,
What about bonds?
they recommend a barbell strategy.
A barbell strategy.
Yeah, basically combining shorter duration instruments with some longer dated, high quality bonds.
Hedging your bets.
Exactly. Balancing the risk of rising rates with the potential for higher yields.
Makes sense. And they also mention currency exposure, right?
Yes, especially with those divergent global monetary policies we talked about.
Right, so don't just think about what you're invested in.
But also what currency you're invested in.
It's an extra layer of complexity.
It is, but it can make a big difference in your overall performance.
I feel like some listeners might be feeling a bit overwhelmed at this point.
It's a lot to take in.
A lot of moving parts.
It is. But here's the good news. You don't have to be a financial expert to make smart decisions.
So what's the most important thing for people to remember?
Stay informed. Be curious. Keep learning.
And don't be afraid to ask questions.
Exactly. There are resources available, financial professionals who can help.
Knowledge is power.
Especially when it comes to your money.
This has been a fascinating deep dive,
Full of twists and turns.
but I have a feeling there's more to uncover.
There always is.
More layers to this dollar mystery.
In the final part of our deep dive,
We'll explore some of the broader implications of this dollar strength.
is this a temporary blip or a sign of a more fundamental shift?
Big questions.
We'll delve into all of that after a quick break.
Okay, so we're back and ready to wrap up this dollar saga.
It's been quite a journey, hasn't it?
It has. From the Fed's balancing act to the shadow of trade wars and a global monetary policy landscape that's more diverse than ever,
And through it all, the dollar has stood strong.
defying all expectations.
It's a puzzle that really challenges our understanding of how these things usually work.
It's exactly. The dollar's playing by its own rules, rewriting the textbook as we speak. But the big question that I keep coming back to is this just a blip? A temporary phenomenon?
Or are we seeing a more fundamental shift in the global financial order?
That's the million-dollar question, isn't it?
It is, and our source offers some really interesting insights that suggest This dollar's strength, it could be a sign of something bigger,
A sign of what?
of a new era. One where the old rules about monetary policy and currencies, they don't apply in the same way anymore.
A new era. New rules. That sounds a bit daunting.
It's definitely uncharted territory.
So what's driving this potential shift? What are the key factors at play?
Well, they highlight a few key trends that are reshaping the global economic landscape. For one, there's this growing divergence in economic policies between the U.S. and other major economies.
So the U.S. is going its own way.
In a sense, yes. They're taking a more cautious approach focused on controlling inflation.
While other regions are more focused on stimulating growth.
Right. They're leaning more heavily on those easy money policies.
So we're seeing a decoupling of sorts.
Exactly. And this decoupling, it's creating new dynamics in the currency markets. Dynamics that challenge our traditional understanding of how interest rates and currencies interact.
It's like the tectonic plates of global finance are shifting.
Creating new fault lines and potential tremors.
So how do we even begin to navigate this new terrain?
I think the key word is adaptability.
Adaptability.
We have to be willing to adjust our assumptions, challenge our old mental models.
And embrace a more flexible view of the financial world.
Exactly. The old playbooks, they might not work as well in this new era.
So when it comes to investing, what does adaptability look like in practice?
Well, for starters, it means recognizing that diversification, it's more important than ever.
Don't put all your eggs in one basket.
Especially when the basket itself might be changing shape. Spreading your investments across different asset classes, different sectors, geographical regions, it can help to mitigate risk in a world where correlations are constantly evolving.
So think broadly. Don't limit yourself.
Exactly. And pay attention to currencies. The old relationships between interest rates and currency values, they're changing as we speak.
So consider those cross-currency hedges.
They can offer valuable portfolio protection in this kind of volatile environment.
So much to think about.
It is. But ultimately, it's about staying informed, being proactive, and adapting to the changing landscape.
Well, this has been an incredible deep dive.
It has. We've covered a lot of ground.
We started with a simple question about the dollar's strength.
And we ended up exploring some of the most profound shifts happening in the global economy.
Exactly. And what we've learned is that the dollar's strength, it's more than just a currency story. It's a reflection of these deeper shifts that could reshape the investment world as we know it.
It's a wake-up call.
It is. So as we wrap things up, what's the key message for our listeners?
I think it's this. The world is changing. The old certainties are fading and new patterns are emerging. Don't get caught off guard. Stay informed, stay adaptable, and stay engaged with the forces shaping our financial future.
Wise words to end on. Thank you so much for joining us on this deep dive. And to all our listeners out there, stay curious, keep learning, and happy investing.